Hello, everyone. Welcome to our latest Sifted Talks in partnership with Navan. I'm Tom Matsuda, Sifted's fintech reporter, and I'm super excited to be moderating this very topical talk on how to balance profit with growth. So just, I guess, to give kind of a few top lines of what we're going to be speaking about. During this talk, we're going to be tackling how the current macroeconomic environment is impacting on startup CFO strategy. We'll be talking about where startups should invest and where they should cut back, and how you kind of navigate those trade-offs internally as well. And of course, it's 2024, so we are going to talk a little bit 2025, sorry. And we are going to talk a little bit about how AI can help in terms of reaching and maintaining profitability. But before we get into it, I want to introduce our amazing panelists. So today, joining me, I have Tamara Orlova, CFO at female health app Flo Health. Tamara was the first person to join Flo's finance team back in 2019 and has overseen the company during a rapid growth phase, during which it became Europe's first femtech unicorn after raising a $200 million round in August. I also have Alexander Langholz-Baikousis, I hope I'm pronouncing that correctly, who is the CFO and operating partner at VC firm Cherry Ventures. Alexander has been at Cherry for 9 years, but before that, he was at Morgan Stanley, where he helped take companies to IPO. Also joining me is Amy Butte, Chief Financial Officer at business travel and expense management platform Navan. Before that, Amy was CFO of the New York Stock Exchange, where she led its transition to a for-profit publicly traded entity. So I'm sure she has many stories from that time too. Yes, really looking forward to hearing from our panelists. But I guess just to do a little bit of housekeeping before I start. So at the bottom of the Zoom talk, you should see that there's a Q&A box with a little question mark in there. Please do feel free to send questions in whenever you can. And I guess unlike other kind of panels, there isn't going to be like a separate section for Q&A. We'll kind of take them as and when they come and as and when they're kind of appropriate in the conversation. You also have the option to upvote questions as well, so we know which ones are the most popular and which one everyone wants to ask. I really encourage you guys to do that as well. Please don't be shy. We want this to be as kind of interactive as possible. And I'm really looking forward to this lively conversation. So just to kick things off, I thought it could be good to start with a few questions on why it's so important for startups to prioritize profitability in 2025. So after the boom years of 2020 to 2021, we've seen VCs and the companies they back prioritize profitability over the kind of growth at all cost strategies we've seen before that. So, rather than prioritizing metrics like user numbers or downloads, VCs are more interested in a startup's top line and how close the startup is to reaching profitability. And if they're already there, how can they maintain it? And with that in mind, I kind of want to open the floor to our panelists. How has the current macroeconomic environment reshaped the way startup CFOs are approaching balancing profit with growth? Amy, would you like to kick us off there?
Sure, I'm happy to. And Tom, thank you for having me, and great to be here with everyone, with Tamara and Alexander as well. Look, Navan is outside of that early startup stage, but I think an approach to discipline is important for a company, regardless if they're at the very beginning, in the middle, or close to public status. I think investors have decided that showing discipline or the ability to be cash flow positive is something that they are prioritizing. For someone like Navan, we think about this discipline as being an illustrative, if you will, of our maturation process. It's a natural evolution that we can do this. Of course, we still have many avenues for growth. We'd still like more capital to put to those growth areas. And we can talk about that allocation strategy, particularly when we get to AI in the conversation. But I think it is even more important for earlier startups who maybe 5 years ago could have depended on a second round, a third round, more money coming from their seed investor, to realize capital just isn't as easy to find. And so that profitability isn't only a measure of your discipline, it's also to a certain extent important, for your kind of ongoing business operations. So I think where you are in your stage really matters, but overall investors are kind of saying this is a metric that's important to us now as well. I will say, sorry, and just to add though, it's interesting though, public investors will actually give you more valuation for growth, but they still want the profitability. There's actually like a 2+ multiple on your growth factor in your rule of 40. So in many respects, investors kind of want to have it both ways. So maybe that doesn't change whether you're private or public.
Alexander, would you agree with that? Do investors kind of want it both ways?
They always want it both ways, yeah. But maybe let me start with saying thanks for the invitation. Happy to be on this panel and provide our perspective, and mine personally. And maybe what's also important to note is we're an early stage investor, right? So think of us as the first institutional capital usually into a business. We back entrepreneurs very early on, and that ranges from seed, pre-seed, seed, Series A. And of course, I do agree with Amy that things have changed dramatically over the past years. What I would say though is when you take our core stage, which is still seed, people maybe they have a product and they're just launching. The primary goal for these people, for these companies, is finding product market fit and testing the go-to-market strategy. So hardly we can be too strict here on profitability. We would want them to see to test things and grow. We obviously look very early on. We look at how do customers behave, how does retention look like, etc. And that's the initial check, right? But and Amy alluded to that too. We of course back our founders along the way too. So we would also then follow on. And I think when it comes to the follow-on investment decision, where we partner obviously with later stage investors, I think there it's a bit different, and that has changed. And with that, I mean Series A, B type rounds. There it's for us very important that people can prove that the unit economics actually work. And I think what you've seen like 3 years ago, you could get away with proving that maybe at Series C, D stage, so very late sometimes. And I think this needs to happen now much earlier. And I would say that's a key difference. And you want to show that trajectory, a clear plan. How can you grow, but do it efficiently? So capital efficiency, I think, is a key aspect that wasn't so much in the focus back then, but obviously is now, because money is just, there is money in the market. I mean, look at the venture capital space in Europe. There's lots of funds. We just raised $500 million earlier this year and announced it. So obviously there is, but people are more selective because you always need to ask who's gonna fund the business going forward, right? And I would say that those are the key differences. And if you go back to the early stage, we want people to grow and just test things more efficiently. Think about more carefully. If you expand into a different region, does it really make sense? Is this the best way to go? And what we often saw is lots of funding also leads to people just trying out a lot of things.
Yeah, Alexander, I don't know if this is your experience at Cherry, but from my involvement with the seed stage here in the US, there are a lot of seed capital firms that are actually running low on dry powder too. And so you've got to be thoughtful when you think about what firm you work with, not just what they can invest the first time, but also how much dry powder do they have to support you in case the markets do freeze going forward.
Yeah, 100%. Also for us, the fundraising environment it's not the same anymore, right? So It's definitely I think it takes a bit more time to trickle down for funds to have a harder time. We don't raise every year. We raise every few years, and so do other seed investors. So that's definitely a factor. And one key measure, or let's say one key KPI that an early stage investor is measured upon, or should be by founders, is as a seed investor, how much is that going to help me raise the next round? Not only invest, but also raise the next round. And that's, I think, a key KPI that, founders are looking for, or very good founders should be also looking for. What are they going to do to help me, and how they're going to keep investing too?
Yeah, definitely. I mean, we'll definitely come to KPIs in our conversation for sure. But Tamara, I just was curious. I see you nodding along there. I wondered how your kind of experience in transitioning Flo Health from kind of a smaller startup to when you joined to this kind of rapidly growing scale up. How has that kind of experience influenced your approach to kind of balancing growth with profitability?
Yeah, yeah, I guess I'm also starting with hello to everyone, and thank you for having me in here, Tom. And I think in terms of the overall environment and sort of the approaches that like different stage companies take, I do agree with a lot of what Alexander and Amy were talking about. I guess we are at Series C stage. We've just raised Series C last year, crossing 1 billion in valuation, and I totally agree. I think for our stage of growth, first of all, it's absolutely expected, and frankly, I don't think it's even possible to raise without it at the moment. It's absolutely expected for the company to have a very clear path to profitability, if not being profitable already. I also agree on the unit economics point that Alexander brought up, but I guess that's, as Alexander said, that expectation is there even much earlier. And also, like, having said that, I would also emphasize that, yes, the expectation is actually both on profitability and growth. And I guess to illustrate what Amy was referring to, as in investors do allocate premium to high growth companies, I think it's very understandable why, out of more than 6,000 publicly listed businesses in the US, there were only like less than 300 that were growing more than 30% last year. It's even less if we look at 2025 projections of growth. So high pace growth does contribute a lot into valuation. So it's almost, to me, it looks like your path to profitability is a must-have to even being able to raise. Your growth profile, however, does define multiple quite a lot.
Yeah.
At least what we've observed. I don't know if Alexander and Amy would agree.
Yeah, I think that's the right context, right? If you're free cash flow positive, Series B, C stage company, even, I mean, that's also rare, but let's say you break even on a profitability level, but you're not growing much, or you're growing 10, 20% year on year, you're probably going to raise money, but you won't raise it at a valuation that you probably dream of.
Yeah.
I think we've seen that, we've seen, I think, fantastic business models there. They're even unique in their own space, international profile, US, Europe. And, a few years ago, you would have probably gotten a 20x on the top line, and maybe now you get a 6 to 8 times. Unless you're doing something very different with regards to AI, and you've been able to cut your cost base, etc., work more efficiently. I know we get to that point. But if you actually can at that level still grow much more than that, then you also get a premium, yeah.
And we all see examples, right? Duolingos of this world and like multiples that are attached to it. And also, interestingly, last year, Rule of 40 has existed forever, and it's still there. It's still something that people refer to. Last year, I think JP Bullhound in one of the articles came up with Rule of X or Rule of 10, right? Where it's almost the same, but they do put a larger weighting to revenue growth, which is also reflective, I guess, of the same trend. So yes, you have to be profitable or on your way and like have clear strategy around, but growth does matter a lot for the actual valuation.
Are there any trade-offs you've had to make between growth and profitability, Tamara?
Yeah, I mean, I guess it's a constant trade-off, right? Like we can hire more and raise more, or we can be conservative with how we grow and not having to like go to market every 2 years and raise more and more. I think Flo always took rather conservative approach. We didn't have to raise much throughout the existence of the company. We up to like Series C, we raised altogether less than 100 million. So I guess our approach was always rather cautious, and I think starting monetization at earliest stage was also part of that approach. And I think that gave us a lot of flexibility, like despite attracting not so much outside financing, we were able to invest a lot into R&D. Our R&D investment was hundreds of millions actually throughout that period, but we were able to finance that at least partially by our own cash that we've been generating. So I think different companies take very different approaches, but there is always this trade-off. I have these conversations with heads of product, with heads of engineering every year at the budget time, because they always need more people. And that's understandable. We want to grow, we want to invest. Product is the main priority for us. But for me, as a CFO, I have to take a position, and mine was always being very mindful of how we grow and sort of what that generates.
We talk about it much more than once a year. I feel like we're talking about it, at least once a month, if not once a week, in terms of making choices. And I think being agile is really important when you think about that trade-off. I know for us, we are near the place of hitting 70% plus gross margin. Beyond revenue growth, I think gross margin is another metric that investors are looking for, and then kind of that profitability. As we've gone from mid 50% gross margin into that 70% gross margin, leveraging AI, which I know that we're going to get to later, and how we did it. Now it's actually a really interesting conversation. It's no longer about how do we use AI for improving our gross margins, but how can we now use AI to grow that revenue? So I think as you move through that scale of getting to a place that investors are looking for and gives you the flexibility to invest more in growth, you can start to make some of that switch.
And I guess just before we get onto the topic of AI, there's a question from the audience, which from Eric. He's asking, so what are the 1 or 2 key KPIs you should prioritize as an investor to assess whether the startup is progressing towards profitability? Alexander, maybe you want to take that question.
Yeah, especially I think what we would want to see is what we look at some point, again, maybe not at seed, but afterwards, we would look at the burn multiple. So how much are you burning net to generate net new ARR? And you'd want to see that get more efficient, and that over time, I think is something that we track across the entire portfolio, which is obviously hugely interesting because we have over 100 companies. But you need to do that with obviously a clear, I think, view on the stage of the company, the sector of, the sector they're in, etc. So obviously there are vast differences, and given we invest quite agnostically, you really have to compare you have to compare apples and apples. So it's not going to be the same for everyone. But that's definitely something that it's very tangible that we look at once a company at least has, I would say probably at Series A and beyond.
And, Tom, even though you mentioned my experience at the New York Stock Exchange and Navan is beyond that seed stage, I've actually been an entrepreneur in a seed stage company. I've been an investor in seed stage companies. And I love working with companies as they go from private to public. That's no surprise. But one of the things that I like to look for, and I also try to practice, is even though you're early stage doesn't mean you can't think ahead. And so making some choices, whether it's hiring somebody to do finance, showing that you're kind of thinking about these topics, that it's just not all about the product, but you care about the infrastructure that you're building, making choices on some of the systems and the tools that you're using. I think that also shows that you're looking ahead to the future rather than just being, in the moment. And I think that's another thing where startups can really differentiate themselves.
Yeah, and actually, just on that, I think, it's a great point. And I think on this, it's also a great trade-off, actually, right? And it's also something that probably became even more challenging lately with those expectations around path to profitability and maintaining high growth, is how do you balance your immediate priorities that sort of affect your revenue now or increase your profitability now versus the investments that sustain the business in a long term? That's another interesting one, and that's another where startups do have to make choices and do have to make trade-offs. We're always trying to keep at least some swim lane, because it's very, very easy to get sort of into the loop where you just keep prioritizing something that affects your revenue, something that boosts the growth immediately or increases your gross margin or your net margins immediately, but then you're not investing sufficiently enough. I guess what Amy was referring to as well. You're not investing sufficiently enough to sustain it in 5-10 years from now. So that's another interesting trade-off and another decision point, I guess, that we have to make every day.
Where do you believe startups should kind of focus their investments during challenging economic times, and where should they consider cutting back?
I guess the ideal answer will always be focus on your core, focus on your product, focus on your value proposition, and try to cut on everything, on the rest. But then it's always, easy to say, but your product investments usually would be your largest expense as well, right? So I guess coming back to what I was saying earlier, it's a bit of a trade-off on both, but certainly trying to keep as much investment being focused on your long-term sustainability is quite key.
I think you can make, really good choices along the way. You don't have to pick the most expensive option all the time, and you don't have to pick the least expensive option all the time. I think you can be strategic in that. I'm a little biased, right? I'm on the board of DigitalOcean, which is, a cloud computing platform that is really easy to use and much less expensive than AWS. And for a seed stage company, that could be a really good choice rather than pick the really expensive AWS option when you're first getting started. You know, Alexander's nodding, like I'm hoping that he has some of his portfolio companies on the DO platform. You know, at the same time, people may not realize Navan, for example, has a product-led growth option, which has 0 trip fees for expenses and makes it really accessible for seed stage, early stage, or SMB companies. And I think making sure that you spend a little bit of time understanding the landscape on your biggest spend, right? So if you're in sales, travel can be a big spend. If you're, you know, using cloud computing, that's a big spend. But if you really think about your top 3 or 5 spends, spend a little extra time and maybe try to think outside the box.
Yeah, it's interesting because I think, you know, probably the founders that do spend more time on it, and we think that's a good thing, they don't get enough credit yet for it. You know, think about how do you use your capital efficiently, efficient scaling, right? Because the market's only moved to that. And I don't think it's being discussed in board meetings, and it shouldn't be probably in detail, but you want founders to think about that earlier rather than later, because it's also hard to reverse these things later on, right? If you're bigger. What we of course see is where you see huge differences. If you have an entrepreneur that has done it before, he or she will spend more time thinking about these and comparing notes. So one thing we do is, which many VCs do, but it's an important piece of the puzzle, or you know, our value add is we try to offer comparison, right? You work with us and we're like, okay, you get a good deal through Cherry. Okay, that can be attractive, but also what other things can you do? So within a team that I lead here, we try to do exactly that within the platform. Now we can't do that for everything, but for certain things, we can give guidance on where to save money. And that's been in the last 24 months, 24 to 36, much more topical than it has ever been before, right? Whether that's how do I spend, you know, money efficiently on certain tools, or what do I do with on the bank account if I have too much money on the bank account, right? That never I never got that question up until after SVB. What do I actually do with the money? How can I generate more money without taking too much risk, right?
Mm.
Look, crowdsourcing or finding community is so important. I mean, I remember when I was a founder, you know, you kind of feel like you're the only one going through it, and you're not. And
Yeah.
even today, I have like a SaaS CFO channel in Slack with, you know, 30 CFOs of SaaS companies. And it's amazing how we're constantly asking each other questions. You know, find
Yeah.
your safe space and challenge the assumption that you can't efficiently have access to tools, whether it's, you know, Navan, or that you can't go against the grain on certain areas. I think that's really, really helpful, no matter what stage company you're at.
Yeah, 100%, because I would say we get so many questions from the portfolio. We certainly don't always have the answer, but someone else in the portfolio will. So that's a very powerful thing, right? Sharing. And then you wouldn't believe how, especially if you take CFOs, how open everyone is to share, right? Even if you don't have an immediate benefit from it. So totally agree, yeah.
Yeah, I can definitely see how establishing community in that way can help across kind of different disciplines. I guess just to bring the topic to AI, as I know, yeah, we're curious kind of touch on that. How is AI being currently leveraged by finance teams to kind of drive profitability and support expansion? Amy, I know you mentioned in one of our pre-panel calls that AI is kind of a focus at Navan. Could you kind of share insights on how Navan is using AI to innovate in the finance function?
Sure. I mean, well, specifically, we've used AI to expand those gross margins from that mid-50 to that 70% range. We've done that by leveraging AI in our customer support experience. So right now, over 55% of all the customer support requests go through our AI bot, Ava. So it doesn't even get to a person the majority of the times. And we have very high CSAT scores, even with Ava. It's, competitive with our in-person. And actually, I was sitting on the customer support desk 2 weeks ago in Lisbon, and I realized the fact that they have such a high CSAT is even more amazing, because by the time it comes to them, that means all the easy stuff was already taken care of, right? So what's really amazing is how we've been able to do that. Then in terms of finance, we are kicking off kind of finance transformation. We've made a choice that we will not select a new vendor unless they use AI too as part of that. So we just went through a whole procurement review. We picked a company called Zip to be our procurement partner. And they leverage AI in what they do to help us be better. So, that's one way. Two, we're thinking about how do we use AI internally to track information. For example, we are trying to track different risks within our org, and we're going to be able to use AI to just kind of say, hey, I think I found a risk, and be able to leverage it into our risk matrix. We're even using AI in terms of creating podcasts to explain complicated terms and issues to people and to make it personal. Yes, the bot sometimes hallucinates, but you can manage it. But we think a lot about AI in finance, and we're also really thinking a lot about using AI in terms of making the product itself better for the frequent traveler.
And Tamara, are there any ways that the finance team at Flo are incorporating AI?
Yes, we found AI being very helpful on predicting customer behavior side of things. And this is quite heavily deployed by marketing. So for us to be able to assess the effectiveness of investment into acquiring users, we need to understand LTV of this user and how well those users would convert into paying users, how well those users would retain, and deploying AI in generating those predictions at user level was really, really helpful. In sort of traditional finance, I think probably every or almost every P2P tool now would offer AI based functionality. So I think AI is quite well deployed in processing. I think that many companies now, many vendors now explore using it more on reconciliation side of things, like Flowcast, for example. I think they are kind of having that as a relatively new feature. FP&A solutions, FP&A tooling, I can also see that they're trying to deploy it more on the analytical side. I think it's still early stage. I think we are yet to see how well it could work on all those different levels. For sure, reducing the processing job, yes. Analytical, a little bit earlier stage as I can see it, but very interesting application. And then again, I think, as I said, almost every vendor would advertise AI a lot. Still, probably very, very early stage. Still, I would say that we get a lot of reduction in sort of human effort coming from automations, but the portion of that attributable to AI usage is probably still low, but probably more to come.
By the way, Tamara, we talk a lot about the fact that there are people that are talking about it and there are people that are doing it, right? And Navan, we're definitively doing it for our customers. And we're also being very focused on making sure that our new vendor relationships are using it too. I'm fortunate that I have the CIO organization reporting into finance. And so we can the CFO CIO partnership is very powerful.
For sure.
And Alexander, I'm curious, are you advising portfolio companies to kind of incorporate AI into their finance function at the moment?
Well, yes. There's no way around it, right? If you don't, you have a problem, not later, but already now. I think what we've seen, of course, we've some, folks adopting faster. It really depends on what you're doing also. I think what we've seen very quickly is if you not only looking at the finance function, but an obvious low-hanging fruit was customer service, customer success, where we have seen some of our companies in the portfolio doing, generating massive efficiency gains and just then being able to scale quicker has so many good impacts, right? Without mentioning names or something, one thing that came to mind as I was speaking to a founder in the IT services space. I mean, think of the customer service angle there. They've been basically they're able to now cut the customer service cost by 2/3 or so, and at the same time it fuels customer retention, etc., customer satisfaction. So that's obviously going in front. If you move then, or let's maybe mention another example, fintech. In the fintech space, fraud detection is a big thing where AI is hugely useful. And then generally across the portfolio, when you go back to the finance function, I think accounts payable and accounts receivables, we see different kind of solutions there being deployed, at least so far in our portfolio, which is great. Yeah, and then I think Tamara, you mentioned it. When it comes to FP&A teams, they use it for cash flow cost forecasting or general analytics. So obviously there's always humans involved, but I think they can do these tasks much faster and probably at better quality.
I think
And
we're
just
still at early stages with how far we have to go. I think there's, I think I'll use an American baseball term, but we're early innings, if you will, in AI, for the finance team. That being said, I think there's a strategic imperative to have AI in your offering and to be part of an AI solution rather than being in a position to be defensive. There's a big shift going on right now in terms of point of view. We'll see who wins, but it used to be it was better to be more SaaS revenue rather than usage-based revenue. And now there's kind of a shift that it might be better to be usage-based revenue rather than SaaS revenue, because a lot of the SaaS revenue could potentially be replaced by AI, right? Databases and searching databases can be replaced by AI. So it's a really interesting shift in terms of the conversations that I'm having with investors on this usage versus SaaS. And so I would just kind of encourage people, yeah, there are ways to use it within the finance function. There's going to be a lot more a year from now, 2 years from now, and better use cases. But the strategic imperative in terms of your product offering is really critical. Maybe not for Flo, I don't know, but
it is, and I guess echoing what you said on the sort of customer service side of things, I would also add that it's a game changer in a lot of other product related areas, as in localization has been very different for us since we started deploying more AI into that. Content creation, more and more companies are going that route. I think it's a drastic change. It's absolutely crucial to be on top. I think probably hard to name a company that would not be able to deploy AI efficiently, at least on the cost saving side of things. And probably more and more we're seeing that becoming part of the kind of core product or core value proposition as well, and thus in increasing the sales. So I think it's just part of the reality. There is big responsibility that comes alongside that, right? Because there are lots of areas, and Flo operates obviously in a very sensitive area where it's health-related information, and the accuracy is very, very critical. So we still have to put human touch on top of AI to make sure that we are in control, and to make sure that it's still verified and accurate. But it's just like, it's a new reality. It's I think it's on all of the roadmaps. I would expect.
By the way, and it's fun. It's really fun. Like
Yeah.
I love, being a part of Navan, because we get to talk about how the tool, makes people happy and they travel, and it makes CFOs happy because they're saving 20% plus on their travel budget, and saving time because it only takes 6 minutes to book a trip rather than, an hour plus in terms of searching. But it's also really fun to think about where all of this can go. I mentioned we're shifting our resources from margin expansion to revenue growth. And, when we think about how we can leverage AI for the frequent traveler, and be proactive and say, hey, Alexander, we see you're on your 5th trip in 2 weeks, and you're ending in a different city on a Friday at noon. Are you sure you don't want to stay over? And there's this really cool thing that we think you'll like, whether it's a sporting event, an art opening, or a restaurant that you like. I think there are some really amazing things that are coming down the pipeline, and it'll be fun for all of us to watch.
And then just to kind of step back with a question from the audience. So Benjamin is asking, so as CFOs, how many people do you have in your teams, and how do you justify your resources when the focus is on product hires?
I can start. We have about 20 people in finance overall. And I guess coming back to automations, coming back to, part of that is AI usage. I think the change in the need of human resource has been very visible in last couple of years. In the 20 people I mentioned, it includes procurement, FP&A, and accounting, which is like a lot of data processing, is such a lean team for us because previously it probably would be times larger by this stage. But yeah, new technology and new approaches as well, they do play a large role, I would say, in last couple of years.
Amy, is there anything you would add to that?
I'm not sure we're the right example. I think size is dependent on where the company is in its stage. Alexander might have a better benchmark for the number of people in finance for the companies in his portfolio. I also think you need to be careful on just asking a number because, some people have just controllers, some people have FP&As, some people expand it to tax versus outsourcing. And so you might be more, there might be a different metric rather than just the number of people. I don't know, Alexander, how you think about it for your portfolio companies.
Yeah, maybe exactly. Look, it really, I mean, look, we have everything from companies that are worth a few $1 billion to seed stage companies. So hard to generalize. But I think one thing that I've learned over the past decade, typically finance people are hired too late. And typically every company has a CFO a little bit too late. You can get away with it a long time if you're a SaaS business and you know, but I would certainly, I would more also, rather than telling you exact numbers of, you know, this is how many finance people or the finance team, what it looks like in a seed stage company, I would really make it dependent on what the business model is. The more complex your financing structure is, your P&L is, your cash flow statement is, because that obviously brings a lot of topics. The more complex that is, the more, you know, you should have people being good at that and managing that. Look, we've had a seed company that raised now 25 million. And there's a lot of things that come up, right? First of all, you're looking at CapEx. Okay, but what do you want to do there? Then you have also working capital topics. And then treasury. What do I do with 25 million? What's the liquidity ladder look like? So you can do that as a founder by yourself, but I don't think you're spending your time right then. So then I would say as a seed stage company, you need a CFO right away, or I would advise you to do so. And then be also as a sparring partner to the founder, right? I think that's so critical.
Why do you think they're hired later on in the
There's
process?
a friend of mine who just launched a business called thefractionals.net, right? Because even if you can't do it, hire someone on a full-time basis, there are plenty of services.
There are ways.
There are ways to do it. And that kind of goes back to building that community and building the resources that are there to support you.
100%, yeah.
And I guess, yeah, just to move the topic along, I'm conscious of our time that we only have 10 more minutes, but we did obviously want to speak about spend and expense optimization and KPIs to measure ROI as well. I guess this is a question for kind of all of us here. What would you say are kind of the most critical KPIs that startup CFOs should track to effectively measure ROI in today's environment? Tamara, maybe you want to kick off with that.
Yeah, I suppose for us, again, it goes back to, first of all, identifying what is your main area of investment, what is your main areas of spend, and where you want those controls to be tight and very well defined. I think for us, one example is marketing, and there are traditional ways of measuring performance marketing efficiency, which goes down to LTV to CAC, as well as the length of payback period. We've been tracking both, and we've been sort of balancing between the two. And that goes back to, I guess, to what Alexander mentioned in the very beginning regarding, does your user economic even make sense? So it's very substantial and very crucial for products economics. Then I would say that on sort of like product investment, R&D investment side of things, this is where benchmarking is important, because you can calculate lots of standard KPIs, but it is really important to keep an eye on how do we do compared to where the market is, and actually there are ways even beyond like your investor community or financial community. There are toolings that actually benchmark you against very different KPIs and very different metrics, as in how efficient your engineering function is, how efficient your sort of spend in different areas is. So that's very interesting, and that's also what we keep an eye on. But yeah, as I said, it starts with identifying which areas are your main areas of investment, and then I guess the KPIs attached to that would be coming on the back of it.
Amy, what would you say are the most kind of critical KPIs startup CFOs to track, to measure?
I mean, I think Tamara talked a lot about what the investors are looking for, which is that top line growth, the growth margin, looking at where you stand close to profitability, thinking about net dollar retention, net revenue retention, and whatever is that key driver within your company. Those are all really, really important. I would also really encourage people to think about the return on investment of their major areas of spend, right? So can you look that return on investment? I'll use travel as an example, of course, right? Do you have that visibility? Do you have that tool that gives you the visibility to see, are you getting that return on investment? Because you should, and you should have that tool to be able to see it. It shouldn't be a black box. We look at, for example, how many people are coming into the office? Are we getting a return on investment for the offices that we have? We look at return on investment of people. And so, I think don't just look at those top line public metrics, look at those metrics of your primary cost areas and turn that into a leverage point that can drive value in the organization.
Alexander, is anything that you would add to that?
Well, they were very good answers. You guys already covered the investor lens, which, yeah, of course, it's true. There's some general KPIs that, I mentioned already. We like, when it comes to, I mean, it's obvious, right? I mentioned the burn multiple. It has a bit of a negative, connotation, I think, but at the same time is, the money that you raised, how do you invest it? Ultimately, it should result in especially at the early stage, it should result in a good net new ARR number. Otherwise, you're not spending your money right. So it's it's very plain and simple. But I also like what you mentioned, Amy. Other things that probably maybe investors don't ask so much about, but maybe also should more look into. Why you're having 5 offices if half of the team works remote. And I think these things are becoming more important too. Yeah, I mean, I was also thinking about our firm at the same time. We're also 3 offices, but that's gotten better. Yeah, so I like also these other KPIs that you mentioned, because at the end of the day, it's also money that you're investing into the business.
Yeah, exactly.
Have you encountered any challenges in aligning KPIs across different teams or departments, and how have you?
Yes. Yes. When I arrived last summer, I only laugh because it's one of those examples of how a CFO can be proactive and reduce this confusion in the future. So for example, when I arrived at Navan last summer, there were different definitions for different KPIs, right? For example, what's an active customer, right? That's a classic one. And because we had grown both geographically, about 40% of our business is outside the US right now, and have grown through acquisitions, different groups within the org would have a different definition for active customers. So one of the first things we needed to do was say, here's our definition. Everyone needs to comply. And we're just very close to completing a global data warehouse where all of the data across the org will be using similar definitions. So Tom, you hit on a pain point that is very real, and where earlier stage companies, if they think about it proactively, can reduce that risk or that pain in the future.
And I'm conscious of the time, and we have 5 minutes to go. So I thought we could kind of end things off with, so yeah, I'm sure many people in our audience and our attendees are either kind of part of startup finance teams or perhaps aspiring CFOs. I wondered if we could kind of go around the room in our panel and see kind of what advice would you give to aspiring CFOs or founders kind of navigating this delicate balance between growth and profitability in the current environment. Tamara, would you like to kick off with that one?
Yeah, I guess first, advice would be identify your core areas of focus. It's hard to like focus across, everything, but what is your main, like, what is right for your company in terms of long-term investment versus short-term investment? What is right for your company in terms of what are your main spend areas, and like what should be your controls there? What are the KPIs that are most relevant for your company? Where you are in terms of, do you have to raise soon? How important is it for you to fall into the market standard, or are you generating cash and you can have more flexibility there? Where you are at the stage of growth, I think a lot was referred to that as well, right? Like what is right for a seed stage could be completely wrong for later. So I guess my general advice would be identify your focus areas and put yourself into the right context of where you stand and what should be your benchmarking and what should be your KPIs, etc.
Alexander, is there anything you would add to that?
Yeah, just very plain and simple. Apply the right prioritization. If you're a seed stage company, I mean, you have so many balls in the air. But if you have 6 months runway, we always say that you're juggling many balls, but there's one that's made out of glass. It's called cash. So if that one falls,
Okay.
you're a problem. So that's what I mean with that. That's the most obvious priority, or it should be the priority as an early stage CFO. You need to preserve cash. You need to make sure that business is running. And that also means, that you need to be very close to the business. And you need to be the counsel to the CEO or founder, and giving the right answer when it comes to how does it change if I increase, what happens to our runway if I increase marketing spend by 20% or decrease it? Things like that. As an early stage CFO, you need to be very literate about, and you need to know your numbers. And so with, maybe at a later stage, you're profitable, and you want to focus on treasury management because you have so much cash on the bank account, and maybe, so it's all about prioritization according to the stage you're in. So yeah,
Yeah.
generalistic answer, but I think that's what I see across the portfolio. That's important.
And Amy, what
Yeah,
advice
the
would you give?
best
Looking at-
CFOs that
Yeah.
I've had the opportunity to work with and who I respect the most can have a vision, not just 3 steps ahead, but 10, 20, 25 steps ahead. You need to have a vision and you need to know what to focus on. So the vision is important for the messaging that you're sending to investors internally and kind of thinking forward. And then you combine it with what are the most important right now without forgetting that vision. But your team needs that vision, your CEO needs that vision, your investors need that vision. And I think a CFO really has the opportunity to do that, whether it's in the tools that you're choosing today or whether it's in kind of the strategic priorities that you're setting going forward.
Yeah, amazing. Thanks so much, guys. That's really great, actionable advice for our audience to kind of have to end things on. Yeah, thank you everybody for joining and taking the time to attend this Sifted Talk. And thanks again to our amazing panelists. Yes, so if you're hungry for more Sifted Talks, we'll be holding our next talk on how to expand to APAC on the 9th of April, where my colleague Freya will be moderating a panel alongside guests from Lexori, Yamato, Interlink. There should be more details on sifted.eu/talks. But until then, thanks again for joining us, and thanks again to our amazing panelists for being such great conversationists. Thanks so much. All right.
Thanks, Tom.
Yeah.